respected chairman of SIRC, CA Chinnamasa, in absentia, and the secretary, CA Gilisa, in absentia. And today's speaker, Sandhya Kapur from Mumbai, CA Sandhya Kapur from Mumbai, and the participants. Namaskaram to all of you. And today we welcome you all for a program on Ind As 110. SIRC is conducting a series of programs on all subjects thanks to the webinars which has been started due to Corona. It's about 2 years back. So we have been doing more programs on live programs, and one such program is today's program, and we should I think our program organizers, they have been conducting very good programs, and being one of the office bearer of SIRC, I should thank all the subordinates of our SIRC who have been doing this excellent job. Thank you, sir. And Ind As, which has been made mandatory, which will be made mandatory in future, rather maybe another 1 year or 2 years, it will be made mandatory. And in most of the areas, wherever we go for public issue and all, it has been very mandatory, and not for the small companies, but for the big companies. So enriching ourselves in this subject is definitely useful. And today's speaker, Sandhya Kapur, she had qualified as an All India rank holder in 2008 before passing her commerce graduation in 2006 from Delhi University, and she has rich experience with the big companies where she worked. She is a director in audit practice with more than 13 years of assurance experience with large privately and publicly held companies in diverse industries. And she had worked on large audit pursuits, domestic and international audit quality review, and key audit matters. Possess strong technical knowledge of Ind As and auditing standards. She had handled diversified entrepreneurial and multinational clients as well, French, Japanese, and Swiss. She had technical excellence. She had attended and gives presentations to audit committees. She had handled QIP, IPO process, complex accounting matters. She had contributed to the firm's strategy decisions and innovations. And in the business performance, the exceptional client services she had performed. She had facilitated smooth transition of new clients wins by delivering on proposals, promises, and received appreciation from promoters. Nice, madam. And audit quality review, she had conducted engagement audit with zero quality review finding, performed AQR capital market reviews, and also got engagement reviews from capital market team with no open findings. That's great. And effectively led the role of primary team involving meetings, calls, conflicts management review, and of deliverables of 8 reputed non-SRB auditors, and led the development of templates and dashboards. That's how she had shared her knowledge for complex and complicated audited areas, resulted in saving time and synergies in conducting the audits. And she had been accorded with diversity and inclusive role model awards, represented SRB in developing the study material for ICAI, and received mementos for the same. She has also received an award from ICAI for delivering Ind As training. Thank you, madam. Thank you for accepting our invitation, and we welcome you to this program and make our members enrich on this Ind As. The floor is yours. Thank you, madam. Thanks for that.
Thank you, Mr. Sundarajan. So as told by Mr. Sundarajan, I am Sandhya Kapur. So I have an experience of 13 years in audit practice. Currently, I work with SR Bartley Boy and Company, which is a member firm of ICAI. So, which is a member firm of Ernst and Young. Sorry, and I welcome you all and good evening. So, in case you have any questions on the topic, we can take that through the chat box, and we'll answer all your queries at the end of the session. So let me start the presentation.
Yeah, visible.
Visible? Yeah.
Yeah, visible. Move to the first slide.
Yeah.
Yeah, visible.
Okay, 1 second. Yeah. So today we will be discussing on Ind As 110, which is the consolidations, or the standard name is consolidated financial statements. So given the current scenario, this is one of the important topics nowadays because there are a lot of mergers, demergers, and a lot of transactions happening around the world, and it is very important to understand what things needs to be consolidated as per Ind As and what entities are out of the scope of Ind As 110, and how the investors look at the consolidated entity as a whole. So, in a brief, we will be discussing around the definitions of control, understanding what is control, and what are the entities and the nature of entities which require consolidation, and how does it impact the investors. We will also discuss how does the change of control or loss of control happens, and what is the relevant accounting treatment for that. So to start, the consolidated financial statements, as you know, most of you know, because it was in AS also. So means that you are having one single consolidated balance sheet wherein the interest of all the investors is parked in. That is the assets, liabilities, the expenses, and the equity of all the parent as well as its subsidiaries, which are forming part of the group, are presented as a single entity. So here the word group is very important, since a group means parent and its subsidiaries. It does not include joint ventures and the associates. So whenever you are writing any audit report for this consolidated financial statements, so you have to see that you are writing the audit report of the group and its associates and joint ventures and other entities. Okay, so the group as a word as per Ind As 110 does not include associates and joint venture. It is a separate standard on that. So when we talk about group anywhere in the consolidated audit report, it means the parent and its subsidiaries. And likewise, when you write the basis of preparation in the management account, there also we have to be careful what is meant by the group. And then there are separate financial statements, which are the standalone financial statements, which are governed by the separate standards. And any investments in the subsidiaries by the parent in the standalone financial statements will be driven by Ind As 109, which gives you the option of amortized cost or fair value through PNL or fair value through OCI, whatever option they have chosen, and depending upon the nature of investment in the entity. So that's how the consolidated financial statements are prepared. So these are some of the basic principles of in the preparation of consolidation. So one is the control, which is very important. So a parent or a holding company or the ultimate holding company, these are the words which are used interchangeably. that has to control either one or more entities. So when a company controls one entity or more than one entity, it is required to prepare the consolidated financial statements, so that the users can see there are, the numbers are presented as a whole, and if there are any intercompany eliminations or there are transactions between both parent and subsidiaries, those are related parties, so they get eliminated. So to give a investor or the shareholders and other stakeholders a complete picture, the consolidation requirement is there. And in India, it is there, but outside India, the consolidated financial statements are the primary books, right? They are the primary financial statements. Standalone financial statements are not mandatory, unlike in India, where standalone financial statements of the parent or of the company or any entity are the primary financial statements, and then CFS follows. But outside India, only the consolidated financial statements or the financial statements of the group are required, and there are very few countries where standalone financial statements are also required. Then how do you apply the principle of control followed by this? That what is the definition of control? Whether it is only more than 15% or whether it is through the voting rights or through the power of the board. So we will discuss on what are the principles of control. Then what are the accounting requirements apart from the consolidation? What are the disclosure requirements? How do you do the accounting treatments and other things while doing the consolidation? Then there are certain companies whose business is into acquisition of subsidiaries like funds and other companies, and they acquire those entities with a view to earn profit and then ultimately sell off those entities. So those are the investment entity kind of a nature. So the standard has certain exemptions for those entities because they will have numerous entities who will be the subsidiaries, or they will be holding interest in many companies, right? But the purpose of that is not to uh, you know uh, purpose is to earn the returns on those investment, and they purchase the investments where there are profits and then give the returns to the shareholders. So moving on is, so this is the exemption for preparation of CFS. So this exemption is applicable if all these four conditions are met. So one of the conditions which you might be also thinking, that if it is a listed company or it is in the process of listing or its shares are traded in the market, then there is no exemption. Then you have to prepare the consolidated financial statement on a mandatory basis. And then if the company is a wholly owned subsidiary or it is partially owned subsidiary of any company, maybe 50% or more than 50% shareholding, then all the stakeholders decide that it is not required to prepare the CFS. That can be passed on by a resolution. That is second. Then we have that the ultimate company, which is the ultimate parent, it prepares its consolidated financial statements. For example, if A is the parent company or the company, and then there's an entity B under A, then there's an entity C. So B can be exempt from the preparation of the consolidated financial statements if A is preparing the consolidated financial statement and presenting it to the public. So these four conditions are there. So either there is an exemption from the board or the shareholders, including those who are not entitled to vote. Okay. Then second is, it is not a listed company. It is not in the process of listing. Then the fourth one is that the ultimate parent is already preparing the consolidated financial statements which are available for public use. So if these four conditions are met, then only there is an exemption. Otherwise, in more than 95% of the cases, you will see that there is a preparation of the CFS. Then there are certain post-employment benefit plans which you would have read, like gratuity trust or superannuation trust, or there are provident trust, fund trust. So those long-term employee benefit plans need not be consolidated into the preparation of the CFS, though the entity creates those trusts for them and they have the control over those trusts. But the ultimate objective of that trust is to for the benefit of the employees. They are not earning any return. They are returning that money with interest to the employees. So that's basically a non-profit kind of an organization. So that is exempt from the consolidation. And then we discussed about investment entities. So broadly, if you see, the standard talks about three principles. One is an investor will control an entity if it has a power over the investee. So if a parent has a control over the company, then it should have a power. Okay, and that power should be such that it has the ability to exercise that power. So it not be for the namesake through an agreement or through the person is sitting on the board or something. He should be able to actually exercise that power in order to affect the returns, and they can control the daily activities, day-to-day operations, and they can make the decision making. So they are able to use that power. And then second is the exposure or right to variable returns, so which is as simple as was there in the old AS also, that the all the profits and losses are of the investor. So they have the right in the profit as well as the losses, so all the variable returns are of the investor. Then the third one is the ability to use the power of the investee to affect the return. So these two go hand in hand. So you have to see who is using this power to affect the return. So the third one is related to the power. So power, variability of return, and the ability to use the power. So now you may think that, if somebody is having a say 50% shareholding, so obviously they have the power, they will be in the board. But sometimes, the other shareholders or the other members in the board, they may form a collusion or a group, right? And they are not able to, get those resolutions passed, which company A tries to do. So that's the power of minority sometimes. So maybe the holding company is not able to exercise that power to, affect the returns of the company or make the important decision making as per their choice. So that also affects. And so minority shareholders also play a very important role nowadays. So you will be, hearing there a lot of complaints by the minority shareholders, and there are proxy firms and other firms who, use their powers as a minority to affect the functioning of the company if they're not happy. So broadly, these are the elements of control which we discussed: shareholding, control agreement, and then there is something called as potential voting rights. That means you don't have the voting rights today, more than 50%, but tomorrow you may have based upon an agreement. So we will discuss that in detail. But those potential voting rights should be exercisable. That is, those should be substantive. Then there's a concept of de facto control. So a company may be having ownership of less than 50%, or there may be less number of directors on the board, but they still have the control over the company, which is called as a de facto control. Then ability to appoint the director. So if they are able to appoint the key directors, as in the executive directors, then there might be a control, because that director will be working on the directions of the company. Sorry, what happened? I guess. Is the screen visible, Selva?
Ma'am, you're audible, ma'am. You can continue.
Screen is visible?
Yes, visible. Yeah.
Okay, it's showing some error. Okay. So, so we can move on to this three things in detail. Number one is power. So it is a current ability to direct the relevant activities, what we discussed. So those activities can be the day-to-day functioning, right? Like for example, the selling and purchasing of goods and services. So that is very important part. Sale is the most important part in a company, because through sales only you will generate revenue and cash. So what are the important decisions related to the sale as well as purchase? Then on the operating and the capital and financing policy, which company is able to control, what is the entity that is able to control those, decision making relating to finance, capital structure, and also the operational things. Then the funding of the company. Suppose if one company, a company is dependent upon the parent or any other company for its funding or to obtain the funding, and cannot run its business without that, and that's also important. That's a relevant activity. Depends upon the nature of business of the company, uh, as well as the net worth of that company. Then appointing, remunerating and terminating the employment of service providers of KMPs. So the key managerial personnel, maybe the CFOs, the CXOs, MDs and their relatives. So the company has the power to appoint or terminate those. So those are the people who are the KMPs and they are involved in the day-to-day functioning. So they will be taking decisions on the all above three. So in a way, indirectly you are controlling them. So that's how what is a relevant activity. So one has to see depending upon case to case that what is a relevant activity in that particular structure. And the power, how does the power arise? Like we discussed, it can be through voting rights. That is your more than 50% of the power of the shareholding. So you will have obviously voting rights more than 50%. Then potential voting rights through any convertible instruments. That is, you don't have any rights today, but tomorrow you will have rights because say the debentures get converted into equity. So today you have 40%, tomorrow you may have 50%, right? Then right to appoint the KMPs or the key decision makers, and then the termination or the removal or kick out rights. Then second aspect we discussed was return. So the returns can be in the form of, it can be positive, negative, both. It can be in the form of dividend or remuneration or economies of scales. That is, your business is expanding, your share market share is increasing. So tomorrow if you want to sell your share, it's increasing. Then cost savings. Then you have scarcity of products, proprietary knowledge and other synergies. So there can be any form which a return can take from the point of view of the shareholder. So that is second. Then third is linking the power to the returns. So what is the investor's ability to use the power so that they can affect the return? So that may be through the normal shareholder agreement, or it can also be driven by an agreement. For example, there are sometimes joint arrangements where suppose one person is having say 70% control or 70% shareholding, but the another shareholder having a 30% stake shareholding, that he may also exercise the same rights as the 70% shareholder. So the equity stake is not similar, but their powers are similar, so both of them can affect. So in that case it becomes a joint control. This we discussed. So like if you see this example, so here A and B form an investee to develop and market a medical product. A is responsible for developing and obtaining the regulatory approvals for that medical product or the medicine, and once the approval is received, then B will manufacture and market that medical product. So here if you divide into two parts, what A can do and what B can do. So we have to decide where it will go, whether A is having the control or B is having a control over that entity where the medical product will be manufactured and sold. So A's discretion is on the development and B's discretion is on the manufacturing and marketing. So he's controlling the development side. So one can say if development and regulatory approvals does not happen, that which is an important activity, then the second part cannot happen. And if manufacturing and marketing doesn't happen, the business is not going to work out. So one may have to think that what are the relevant activities in this case. So for this, you may have to see the purpose and design of the investee company, the structure, the new company, maybe they form a company C. So how that company is being formed, what are the factors that determine the profit margin? Like for example, in case of this company, suppose the medical product gets developed and it gets sold in the market, who is getting how much share and how the margins are driven. So are the profit margins purely driven by the marketing strategies which B is doing, or they are also affected by the subsequent research and developments on those products? And then the revenue and the value of the investee as well as. Then what is the effect on the investee's return resulting from each investor's decision making authority? So how the development side and how the manufacturing side affects the returns of the company. So it might be possible that there can be ongoing regulatory approvals and A's need might be there even after the company C is formed. So there can be a scenario that once company C is formed and the product is launched, there is no requirement of further development or further approvals, and there can be a scenario that it will continue to be involved in that process. Then what are the investors' exposure to the variability of return through their agreement? And then these 2 points also need to be considered, that who controls the medical product once the development phase is successful. So that's also agreement driven, how they decide that who will control the product and how the patenting is to be done. Sorry. And uncertainty and effort required in obtaining the regulatory approval, which we discussed. So these are some of the examples, and if you see Ind As 110, there are a lot more examples like that, which will make you think that how to decide that whether A is controlling an entity or B is controlling an entity, what controls which entity. So that's how. So, and sometimes it might not be very simple, it can be complicated also. Now we were discussing on the current ability to direct the relevant activities for the power. So the power arises from rights, which we discussed here. So the power arises from the rights. So what are those rights? It arises from rights on the voting rights, on the potential voting rights, through the contractual arrangements, maybe 70-30, and there's an agreement that yes, the 30% shareholder will have an equal say in the board and the general meetings. Power need not be exercised means it's not necessary that you exercise that power. There should be an ability to exercise the power. So the agreement may say that the 30% shareholder has the same voting right. He may not exercise his rights, he may not exercise that power to influence the decision making, but he has that power. So you should have the ability to direct the activities. You may not exercise that power and prove that yes, you have the power to direct the activities. So if you see the past trend of those two shareholders, 70% shareholder and 30% shareholder, it might be possible that the smaller shareholder has not even exercised the power in the past. So one can say that only a 70% shareholder controls the company, but if 30% shareholder has the right, then you cannot say that it is controlled by one company. And the power does not arise from the protective rights. So what do you mean by protective rights? Like for example, in some cases, a company is having bank loans or certain debentures, and you have to, and the bank's condition is that the one person from their company will be on the board of the company, right? And or one of the debenture holders will be on the board of the company. So those are the protective rights. So they want to protect their interests in the form of like what are the decisions the company is taking. They want to know those decisions so that they do not affect their money which they have invested in a adverse manner. So those are protective kind of rights. So those are not the power, those are protective rights. So they cannot exercise the power, but yes, those are in a way of protective rights. Then a power can exist even if others participate in directing the relevant activities. For example, like A is having say 70% of the shareholding and he controls the company and is exercising the power, but there are other shareholders also who have a significant influence. Like so significant influences are more than 20%, 20 to 50%. Between 20 to 50 is significant influence. So they may also have influence and they can also direct the activities and they can exercise their powers in the board. So it's not necessary that only you are controlling that those decisions. Others can also influence those decisions. That does not mean that you don't have that ability uh, to control the relevant activities. So this we have discussed. So these are some of the examples where you can see, which provide evidence that the investor is having rights that give them sufficient power over the investee, like to appoint or approve the investee's KMPs, uh, contractual right to direct the investee to enter into any significant transactions for the benefit of the investor. Transaction can be, any high wolves or any mergers, demergers. So those are the important decisions or the buyback from the point of view of the investor. Then investor can dominate either of the nomination process of electing the members of the governing body or the proxy firms, right? Then KMPs are investees. KMPs are related parties of the investor. For example, mostly in promoter driven companies, you will see, the KMPs are the promoters, and there are related parties of the investor. For example, here you have given the chief executive officer of the investee and the chief executive officer of the investor are the same person. So they can be a common kind of a CEO or a CFO, or they can be a promoter who has one company, and investor who has one company, and the relatives of the promoter have another company. So in a way, he can exercise influence over both the companies by giving directions to their relative. So that's how. So you will have to evaluate that how much control he can exercise to see whether that power is being exercised, or they have the current ability to exercise that power or not. Then majority of the members of the investees governing bodies are related parties of the investor, which we discussed. This is an example of the significant judgment from the point of view of consolidation, and what is the basis of consolidation companies generally give. So here, if you see the example, says that consolidation joint arrangement, there's a group which say that how they have evaluated joint control over one company. So the group has determined that it has joint control over the investee, and the ownership is shared with other owners. So there might be an agreement between two companies, and there's a joint arrangement. So they are saying that both the investee companies have a joint control. So this is a significant judgment, because one has to read the agreement, one has to see all the conditions, and that who exercises which right, and what are the powers given to both the joint owners. So that's sometimes very difficult to see practically that how those rights are being exercised. So whether it is a joint control or not is a matter of judgment. So in the significant judgments under Ind As 101, you will have to give that this is a significant judgment while deciding when there is a gray area. So when there are clear cut subsidiaries, and there are no other shareholders who have control or influence, right? And it's widely dispersed company, so there it's clear. So that's not a significant judgment. So where you have exercised and you have applied those things that to see whether you are having a power over the investor or not, or the other person is having, and how the returns flow to both the investors. So that's kind of a judgment you have to see. So it says this is a joint arrangement, so they are not consolidated. So once when you have a joint control, you will not consolidate that entity, because then A or and B both have to consolidate C, which is not a right picture. So they will do accounting as per the joint control standard, which is Ind As 111. And this is a basis of consolidation for other company is maybe the subsidiary companies. So it says that to support the assumption, when the group has less than a majority of the voting or similar rights of the investee, right? The group considers all the relevant facts and circumstances in assessing whether it has power over the investee. So it says generally there is a presumption that a majority of voting right result in control, which is more than 50%. But if it has less than 50% of the voting rights or the shareholding, then the group sees the facts and circumstances whether they have actually the power to affect the returns, and whether they can make they can affect the relevant activities, or they can make the decision making and influence use their power to influence the returns and the decisions of the investee. So these are the 4 conditions which are given in the standard. So it shows that in India's vis-a-vis accounting standards, you have to clarify all the assumptions and judgments, and the basis how you have drafted the accounts in a way, right? So everything is true and fair and clearly on the financial statements. And the accounting standard, it was not very much evident in all the financial statements and the accounting policies that what maybe the judgments, or what you can say what stand you have taken on various matters. But in India's in the policy section, you have to mention all this. So okay, then there can be certain special relationships, like the investees KMPs who have the ability to direct the relevant activities. They are the current or previous employees of the investor, right? So if a person is in the KMP, right, there's a company A, and there's a company B. So company B's KMPs, right? They are the employees of company A's director or promoter, right? So he can, they are under certain obligation to, or out of respect or something, they listen to him and they, make the decisions on his directions. So that also kind of a special relationship. So if that happens in most of the cases, one has to evaluate and see whether entity B needs to be consolidated with entity A, even though there is no shareholding or voting right or anything. Then second is investees operations are dependent on the investor. For example, due to funding, they are dependent upon the operations, and there can be significant guarantees which are given, maybe because of the loans or the funding or any business guarantee that company A has given to company B. So if that is important for the business or running the business of the company B, then one has to evaluate whether company B needs to be consolidated into company A. Then investee depends on the investor for critical services like patents, technology, or raw material. So he may be the major raw material supplier to them. Like for example, I give an example where there are certain leasing companies, right? So and say leasing companies or the transporters which have a limited number of trucks, or if they have the trucks, and those all the entire trucks or the entire vehicles, they are used by the one company only, and they are dependent upon that company, and they are structured like that. So one has to see whether a company is controlling those transporters or not, and their vehicles or not. If they are controlled, then consolidation comes into picture. Then there can be licenses or trademarks also, for which your company is dependent. If that license or trademark is removed by company A, then your business, the business of company B might not work. And then this is on the specialized knowledge if you have on the investees operation, but this is very not much practical nowadays. Then significant portion of the investor activities either involve or are conducted on behalf of the investor. That is, they're working mostly to benefit the business of company A. So company B is doing a business, but its activities or decision making in a way are more biased towards the company A, that is the investor. Then the investor's exposure right to returns from its involvement with the investee are disproportionately greater than the voting right. So if you have 50% voting right, but your returns are more than that, okay. Collective control will discuss if there are two or more investors which can collectively control an investee, then they must go together, act together to direct the activities, and this is known as a joint control. So joint control owners can be one, can be two, can be more than two also. This will come later. So as we were discussing around potential voting rights, that they can be convertible instruments or options, wherein you don't have a right today or you don't have the power today to direct the activities of any company, but in the future you will have that right. So while doing the closing the financial year, or while doing the consolidation of a year, say from April to March or Jan to December, you have to see during that period whether the company A has those potential rights as substantive rights. So what do you mean by substantive? That are there any barriers that would prevent the holder from exercising those rights? Does the company has a practical ability, and whether the investor hold the right benefit on the exercise of conversion? So for example, say company has convertible debentures, okay. So there are compulsory convertible debentures with company of company B. So today the company is having 40% right, and after 1 year, when the debentures get converted, then company A will get the shareholding of say 60%. So it will get increased by 20%. Now, whether today you have to consolidate company B into company A or not, that's the question. So for that, you will have to see when the consolidation, when the conversion happens from 40 to 60%. So will company A benefit from that conversion or not? after exercising, or there will be a loss. So you have to see what are the returns of company A on account of conversion. Are there any costs involved, and what are the benefits to that? And if the company A wants to convert that right today, whether they can convert it or not. So you have to see the answer yes or no. So which is no, because sometimes, which is no, because sometimes mostly in compulsory convertible debenture there's a period. Okay, so you cannot convert it today, you can convert it after a period. So that practical ability to do it today is not there, so they cannot exercise their rights today, right? So they are not currently exercisable or convertible. And if there are, optionally convertible debenture, then you have to see what is the probability that company A will be currently getting those debentures converted or getting those rights exercised. So that you have to see what is the probability of that. So say if you company A decides to convert it today, and they can convert it because they have the option, whether that is beneficial to company A in that sense. If the answer is yes, then yes, it is a substantive kind of a potential equity share. Otherwise it is a non-substantive. And then do the holders have the practical ability to exercise? So okay, so they can be an optionally convertible debenture, okay, and which company A can convert. Because there are other shareholders who might prevent from exercising that right to optionally convert those debentures today, because there might be they have to take certain decisions, because today you are holding 40% and they are holding 60%. So they might have to take certain decisions for which they don't want to involve you, right? So they will make that environment, or they will make that practically difficult for you to get that option converted, or they will not get that resolution passed. So is there a practical ability to do so? If the answer is yes, this, then the rights are substantive, otherwise not. So these are the three, four things which you have to see in case of a potential rights. So which is mostly in case of convertible instrument, which are not compulsory, or there's no period that you can convert it after that period only. If there's a period, then obviously today you cannot exercise those rights even if converted. You cannot even convert it, right? So that's all. So protective rights we have discussed, which are related to any restriction from the lender or borrower to be on the board of the company or on the shareholders meeting, so as to protect their rights. Or they can be minority shareholders, or they can be proxy firms and other firms to on the board of the company. Or maybe you have invested in some a sustainability kind of a company, and there's a obligation to obligation for of that company to put one person on board from their side due to the sustainability requirement or something. So those are all protective kind of rights, so they will not be able to influence the decision making. They can only speak when their rights are affected, like important decisions relating to funding or ESG or CSR activities, or something which is directly related to them. Then franchisee, this model was there in the earlier standard also. So where also it was concluded that franchisee model does not give franchisor the rights, and there's no need of consolidation, because the franchisor and franchisee agreement is mostly used to increase the branding, and they work on a model which is developed by the franchisor, but they work on their own terms and conditions, right? And they do the normal sale, purchase and everything. And whether the franchisee returns are affected by the decisions of the investor or not, that's one piece which you have to see. So mostly the answer is no, because they work independently. So you have to assess who benefits from the activities of the franchisee. Is it only the share of sale or profit which franchisee is giving to the franchisor, or it is something more? And what are the relevant activities? So in the day-to-day functioning, normally the franchisors do not involve themselves with the franchisees. What is the structure and how the franchisee was established? Yes, this is important, that how does the franchisor support the franchisee? So whether the franchisee is dependent for the funds from the franchisor to operate their business, or they have launched their independent funding and everything, and they're only selling the products which are meant to be sold by the franchisor. Then variability. So if the franchisee's business is into loss, franchisee's business, then who is going to bear the loss? Now the third aspect, returns. Second aspect, sorry. So we learned about power. Now returns. So which is a simple thing that you're getting a return in form of dividend and everything. So the returns in a way tell you that whether there's a control or there's a power over the investor or not. What is the variability? Are you getting the profits and losses and everything? So that's a simple kind of thing. So non-controlling NCI is non-controlling interest holders. So which is the minority interest. So they also have share in the returns of the respective shareholding, but it's not necessary that they have the power, right? So returns are there, but power is not there. And returns can be fixed, they may be variable, but exposure to return, in order to have a control, it has to be variable. If it is a fixed return, then you are not taking any risk, right? So greater the exposure, greater the incentive to obtain power. Focus on the existence of exposure to variable returns and not on the amount of exposure. So the fixed number may be more, but the variability factor is important. This we have discussed. So now this is something which is important, and there are a lot of companies who do the consolidation basis de facto control. So de facto control means a company A is having a lesser number of shares or less shareholding rights, as in less than 50%, but still they might have control over the investing company. So we'll see this through an example. So there's a shareholder A, okay, who holds 48% shareholding in B, and rest of the 52% is widely dispersed to the public. So now whenever the board meeting happens or whenever the annual general meeting happens of company B, so A will be present, okay, and some of the shareholders from this 52% will be present, but they are all widely dispersed. That means say 1%, 2% or 5% shares are held by different individuals or companies. So A in a way indirectly controls the decision making of B, right? Because for a resolution to be passed, ordinary resolution, you need 50% vote. So there's a greater possibility that A may get the resolutions passed in whenever the board meetings or when the AGMs happen. And in the board meeting, he will have, and there will be some directors, and A's directors will also be there. And from this group, they may not turn up in the meetings because this is very widely dispersed shareholding. So A will have a de facto control in that case. Ki A के पास ही सब कुछ है. A is the one who can control the decisions because there's nobody else to counter motion A practically. Okay, so that's one example. So here we will have to see the situation and see whether A has to consolidate B or not, and whether it has the power to influence the decision making of the company B or not. That's one. And in the example 2, here C is having 45% shareholding in D. Okay, rather than 48, it's having 45. And there are 3 other shareholders, okay, who have 1% each. And there are 2 more shareholders who have 26% each. So now what will happen? So these 3 are only 1%. So major portion is 45% and this 52%, and 3% is with the remaining 3 shareholders. So whenever a meeting will happen, so this suppose any decision has to be taken in favor of C. So C will exercise rights in the favor of 45%, and then the remaining is 5%. So even if these 3 shareholders pass a resolution or vote in the favor of C, there still remains 2% or 3%. So these 2 shareholders play a very important role now in the decision making of D, right? So there may be a possibility that one of the shareholder may collude with C, and they can together control D. there may be a possibility that both of these shareholders together control D, and in every board meeting, because they have 52% shareholding, they can exercise more influence than this 45% shareholder, even if he combines with these three shareholders. So that way, that's an example of de facto control, and that practically happens because in public companies also, and in private companies also, you will see such examples more often. And see, then you have to decide whether there's a control which is being exercised by the C or these two shareholders or not. So if it concludes that the both of these control, then it's a joint control. And if it is get concluded that C controls, then it's a control by C. And it may be possible that no one controls. Sometimes resolutions are passed by in favor of this shareholder or this or C or other three shareholders. That can also be possible. Now, agent principal relationship. So normally an agent works on behalf of principal, and the principal controls the agent also. He gives directions to the agent, okay, and all the decision making authority is also with the principal, and he is only executing the decisions. So whether this principal agent relationship will also lead to the exercise of power by the principal so as to control the agent or not, that's the question here. Okay, so now this broadly we have discussed. This is a summary of what we have discussed so far, the link between the power and the returns, right? So if you link this slide of the agent principal relationship with this, then you have to see whether it is more on the principal side or more on the agent side. So whatever we have heard so far, so this is a summary. You have to decide who is the decision making authority, whether there are any removal rights or not, remunerations are according to the services, who is having the variability of returns. Then on the right side, you will see there's a lesser decision making. There are lesser number of removal rights. Okay, there's a little exposure to the variability of returns from all interests. So then it is more like an agent. So you will have to decide whether a company is more acting more like a principal or more like an agent. So if it is working more like an agent, then you don't have to consolidate. Then if it is working more like a principal, then the companies might need to be consolidated. So these are the de facto agents. For example, related parties. So related parties or the subsidiaries of the promoters or the other groups or companies, they act on your behalf. They uh, they are controlled by the parent companies. So those are mostly related parties, and those are consolidated also. Then a party that cannot finance its operations without subordinated financial support from the investor, that is also dependent upon the funding and everything, that needs consolidation. Then a party with the same board or KMP, then whether there's a common director or common KMP, that does not necessitate that there's a control. One has to prove that, because common director does not mean there's a related party or it's a subsidiary or control is exercised, but one has to prove that. Then rights and returns of de facto agents are considered together with investors' own uh, rights and when evaluating. So it says, say there's a principal and an agent, and this agent is a de facto agent. So and to principal has one company, has an interest in a company, suppose company A. So for company A, the principal decision making authority and the agent's influence on that company A both have to be seen together. Or if agent has one company under him, company A, what is the control which principal is exercising on that company through agent, or the agent is directly. So that can be de facto agents. So even if there are agents or de facto agents, you have to see the consolidation requirement. If it is a principal to principal relationship, that means both are independent companies and both have their own decision making, then there is no requirement of consolidation. So if you want to get a company consolidated, then you have to prove that it's an agent or a de facto agent. Number two, if you don't want to consolidate company B or C into company A, then you have to prove that there is a principal to principal relationship. There is no agent principal agent relationship in that case. So you have to draft the agreement or make changes to the agreement in that sense. So suppose A Limited, which is a manufacturing company, will lose significant tax benefit if it sells goods outside its own selling territory, say India. Okay. Then A Limited therefore sets itself up as a company selling within its territory. B Limited is set up for purchase from manufacturing company and selling in other territory. So here what A is doing, A is saying if as a company he sells goods outside India, then he will have he will lose certain tax benefits. Okay, so he sets up another company for selling the goods within the territory and another company for selling the goods outside the territory. So what B Limited will do, B Limited is set up for purchase from manufacturing company and selling in other territories. So A sets up another company, say C, okay, and B will purchase from that company and sell in other territories. So what in a way he has done some tax planning so that B can sell the goods in other territories and tax benefit is available to A company also, and B is selling the goods in the normal course. So A will sell goods to B, which is within India, and then B will sell the goods outside India. So A will get the tax benefit also, and B since it is a separate legal entity, so there will be no question. So now B has a very thin capital because the purpose only is to purchase the goods and sell the goods, kind of a trading, and is done for the tax planning, and it is held by related parties. So related party can be promoters of A or other subsidiary companies or fellow subsidiary companies of A. Then B has practically no finance because it does not require finance. It just have to purchase the goods and then sell the goods. So there practically there is no inventory, because as and when the order will come from the outside India, then only A will sell to B and then B will supply further. So purchases all the supplies from manufacturing company. So it is dependent upon A for finance, for the sale also, and is operated at a low margin level. So to an extent you have to keep some transfer pricing margin or other margin. Otherwise there is no margin required in B, and uses manufacturing company infrastructure for sale to customer. So maybe the orders comes with A and then they use the same orders to sell to customers. So there is no sales setup or the marketing setup as such. So there's no funding, there's no marketing setup, there's practically no inventory. They're only working as an agent of A, as a de facto agent. So under Ind AS 10, so then B is likely to be consolidated with A Limited. Okay. So now comes the definition of investment entity. So investment entities, one which obtain fund from various companies or various investors. There can be two investors or more than two, and it invests that money into various companies or the equity companies, and then commits to the investors that it will get the return on those investments, and then give it to the investors. And after some time, when the capital appreciation is there, then the investment entity gets liquidated. So that's how an investment entity works. So these are the three major features of an investment entity: that it obtains funds from one or more investors, it commits to the investor that its business purpose is to invest funds solely for the capital appreciation or maybe recurring income, and it measures and evaluates the performance of sustainability of all its investment on a fair value basis. Like you have mutual fund companies and other companies, so those are the investment entities. So they invest in thousands of companies, so practically it's not possible to consolidate that, and maybe they might not have control or power over all the companies in which they invest. So this is fine. So this investment entity normally measures their asset at the fair value, so as to have a true and correct picture at all times. Because if you do not fair value your investment, it will be at cost. Then the investor will not be able to see what is the capital appreciation, what is the return on a quarterly or an yearly basis. So that's how the investment entity does the accounting. And maybe that's also supporting the reason that it need not be consolidated, because the ultimate objective or the ultimate purpose is to give the return to the investor, and not the controlling of those entities. So this is an exception, fair value and profit and loss. So there is one exception where there's an investment entity and it further invests into one more company, which is also an investment entity. So in that case, there will be a need to consolidate the investment entity, because then that subsidiary is also working on the same objective. That subsidiary is also doing the investment in various companies in order to earn returns for the investors. So both of them are doing the same business. So we have to see consolidation from a single entity or a single group, and what is the return the ultimate investor is getting. So in that case, they will have to do the consolidation between one investment entity and another investment entity, but they need not consolidate the entities in which they are investing. So now this is an important topic, change in control and loss of control. So there's a difference between both the terms. So change in control means earlier you were having say 50% shareholding or 70% shareholding, but now the shareholding has changed from 70 to 60. So that's a change in control. But if there's a 70% shareholding and it now comes to 40%, there's a loss of control, that you no more control an entity from an equity angle. So how do you account for that? So in the books of the parent company, you will have to de-recognize the assets and liabilities when there's a loss of control. Means there's the company is no longer a subsidiary. So in the consolidated financial statements, you have to remove the asset and liabilities and any goodwill on the date when the control is lost, and the carrying amount of any non-controlling interest in the former subsidiary on the date when control is lost, right? So you have to recognize both these two, and de-recognize these and recognize this. So we will learn this through an example, otherwise there will be a confusion. So let's see an example. So maybe you can read it and then we can further.
Ma'am, is there any issue?
No, I just paused too so that they can read this example, then
Oh,
we'll discuss the example.
understood. Thank you.
Yeah. So okay, so in this example, what happened? There's a company called DCCDL, and which is owned by the DLF group. Okay, so this is a 100% subsidiary. So during the year, what happened? The stake in DCCDL was reduced to 66%. Why? Because there was one more shareholder who invested in that company, and as a result, the shareholding of DLF Limited was reduced to 66%. And though it became from 100 to 66, there's a change in control, but there was an agreement with that investor and DCCDL that DCCDL will be controlled jointly. So as per the agreement, there were certain terms and conditions because of which it was concluded that DCCDL will be a joint venture for DLF Limited and the other investor. So in this case, now earlier DLF was accounting for DCCDL as a subsidiary because it had a 100% stake, but now it will account for it as a joint venture because it's though it has 66% shareholding, which is more than 50%, but as per the terms of the agreement, there's a joint control, so it cannot consolidate DCCDL anymore. So it has to move out from the consolidated financial statements of DLF Limited. So now what will happen? There's 66% stake. So in this case, when the new company came, and the consideration which was there for the purchase of those shares, that was around 900 crore. So the remaining 34% stake was valued at 900 crore by the valuers. The value is not coming out here. So what DLF did, since it is a loss of control, so you have to de-recognize this company from your consolidated financials and then recognize this remaining investment again. So now earlier the investment was recognized as a subsidiary, now it has to be recognized as a joint venture. So in a way, on the date of the transaction, you have to do two things. One, you have to fair value the new stake, which is 66%, and then you have to remove the existing assets and liabilities from the consolidated balance sheet, and that means because there's a loss of control. So in a way, as per the standard, it is practically you have sold this 34% stake to another company, right? So on that sale, you have to recognize the gain on loss. So how that will happen? The value of the assets and liabilities in the consolidated financials, when you're removing those assets and liabilities, the net value and the fair value of those liabilities, and vis-a-vis the book value of those liabilities, that will be the gain or loss practically. So there will be two things which happen here. So one will be you will have de-recognize the assets and liabilities. Okay, and record the gain or loss on the sale of 34% stake from 100 to 34, because you were earlier 100 and now you have moved to 34%, sorry, 66%. So there is a sale of 34% stake, because of which this DCCDL will move out of the balance sheet of the consolidated financial statement. So when you are removing those assets at the values at which they are appearing in the CFS of DLF, okay, so those values less the fair value of those assets, right? So that will be your gain or loss, which will be a deemed gain or loss, because there is no sale, right? So it's there's no such in the previous accounting standard, there was no guidance on such kind of transaction, but in Ind As there's a guidance to such kind of transactions, right? So if you see this example, it says you de-recognize the assets, okay, and liabilities of the subsidiary at the carrying amounts at the date when control is lost. Okay, so on the date when the control is lost, so you get 66% stake from 100%, that you have to de-recognize, and the carrying amount of any non-controlling interest. So if there is any minority interest, in this case there is no minority interest. So if there is any minority interest in the former subsidiary, say DLF held 99%, so 1% stake in the former subsidiary, that you have to de-recognize. So these two things you have to de-recognize, because if there was a 99% stake, so then DLF would have been consolidating 100% and showing 1% as minority. So both the things you have to move out from the balance sheet, right? Sorry. Yeah. Then second thing is, what you have to do, you have to recognize the fair value of the consideration received. Okay, if any, from the transaction. If there is no consideration, then no. Okay, then any investment retained in the former subsidiary, which is in this case is 66%, at its fair value, as if you are purchasing this investment today, right? So you are selling this 34% and buying this 66%, and then reclassify to profit or loss or transfer to retained earning, whatever is the difference, right? So this resulting gain or loss will be to the parent. So here what we will do, so here the value of the transaction was around I think 917 or 18 crore, if you see the notes to accounts, right? So this 917 crores was purchased, was invested by the other investor, right? So he bought 34% stake, right? He invested to the extent of 34%. So for 34%, there was a consideration of 917. So you have to see what is the consideration for 100%. So if you divide this 917 crores or 917 into 100 divided by 34, so it's 2697 or probably this 2600 crores. This is the number. Okay, so this is the valuation of DCCDL at 100% equity stake. Okay, then this is the working based upon the valuations. They have added the borrowings and everything. So this is the adjusted purchase consideration. Now we have to reduce the fair value of these assets which were in the balance sheet of the DCCDL. So these are all 100% which were consolidated in CFS. So from the 100% consideration, you will reduce the fair value. So valuer would have done the valuation. So we will reduce the fair value of these assets. And this is the excess of purchase consideration, right? Which is here, which is termed as a goodwill, because consideration is more and value is less. Okay. So this is deferred tax created on this valuation of the fair value. That's okay. Then your proportion to this is 66%, right? So when you're recognizing the 66% goodwill in the CFS, so you investments will show it as a joint control, right? So under the investments head, there will be a goodwill which will be 310442, which is a 66% stake. So that's how you have recognized a new investment retained in the former subsidiary at its fair value. So how have we derived the fair value? From the consideration less the valuation of those numbers which were appearing in the consolidated financial statements of DLF, but the numbers pertaining to this in company DCCDL. So that's how you recognize this investment in the books, right? And these numbers will be de-recognized on the book value from the uh, consolidated financial statements. And in this case, while they have de-recognized, there's a gain which is coming of 9927 crores. That is the fair value of these assets less the book value which was appearing for these assets in the consolidated financial statement. So there's a gain. So what happened in case of a loss of control? This is a deemed gain or loss. It would have been written, yeah, there's a deemed disposal in this case. Just because there is no actual sale, because somebody invested in DCCDL, so your stake got reduced. So that somebody who invested in the DCCDL, whatever amount he has paid for the investment, that was the purchase consideration, and taking that as a base, they have valued the 100% equity. I hope it's clear that how to recognize the loss of control. So now on the accounting treatment of the normal consolidation, we have this a small chart which state, how do you recognize. So there's 1st April 19 and there's a company which gets acquired in between 19 and March 20. So from 1st April 19 to the date of acquisition, you will apply Ind As 103, that is business combination. And after that, there will be a consolidation. Therefore, the entire profit will go to the reserves and surplus as per Ind As 110. And say after this date, there's a disposal here. Okay. So post that period, there's a disposal. So profit and loss will not be recognized. And between this period till the date of disposal, the profit will be consolidated. So when you will prepare the financials of March 2021, there will be a profit which will be consolidated from this period to this period in the company, in the parent company. And in this financial year, there will be a profit which will be consolidated from this company to this period to this period. And this example was given because sometimes people ask, see, as on the date of making a financial statement or as on the reporting date, the subsidiary does not exist. So whether we need to consolidate or not. So the answer is yes, you need to consolidate till the period the subsidiary was there, and there was a power which was exercised by the investor. So these are the general principles that you have to combine assets with the assets, liabilities, and how to do the consolidation practically, and then eliminate the intercompany transactions, recognize the goodwill at the time of the recognition. So in when you are doing here, there is no purchase method or something like that. So whenever you have purchased a subsidiary here on the date of acquisition, you will evaluate what is the book value of that subsidiary and what is the purchase consideration you have given. So we were doing that under the accounting standard, but here you will see purchase consideration versus the fair value, because the standard, because India says normally a person pays only the fair value. So if they are paying more than the fair value, then there's a goodwill or a capital reserve, which is here called as a gain on bargain purchase. So there's a gain, so that means your bargain have a good bargain, and there's a bargain gain which was capital reserve in the earlier standards. So here we compare fair value and the purchase consideration, not the book value, right? Because and generally the difference does not arise because people normally pay for the purchase consideration or for the fair value only. And if they pay more than the fair value, that means they are paying something for the brand or some goodwill or some other intangible. So something would be there in the company, that's why they are paying more. So those intangibles have to be recognized separately. And then accounting policies have to be similar while you are consolidating the subsidiaries. And non-controlling interest, which is the minority interest as per the erstwhile standard. So this has to be presented separately. So earlier what we were doing, that minority interest cannot be shown as a negative item. So here we can show it as a negative minority interest or as a positive minority interest also in case of losses. And also sometimes depending upon the agreement with the minority shareholder, it's possible that they may not have a share in the losses, then parent has to bear that loss, and they will not show that as an asset, minority interest as an asset, because they cannot recover that amount from the minority. So what are the major adjustments? Goodwill or consolidation reserves, then non-controlling interest, intercompany balances, unrealized profit if you are selling between the parent and subsidiary and you're selling on a gain and there's a closing inventory, then you have to remove that unrealized gain. Then inventory adjustments, and then any asset transfers. So these are the basic rules you can refer as a checklist. One is issued capital of the group is the issued capital of the parent. So when you're consolidating, say parent has a capital of 100 and there are 10 subsidiaries which have a capital of say 10 or 8 or something like that, so you don't have to add the capital. So the capital of the parent is the capital of the group also. So the standalone and the consolidated financial statement will have a same capital, because it will be ultimately replaced by the investments and asset liabilities. And then cost of investment in the equity of subsidiary is eliminated. Okay, so from the stand in the parents company standalone financial, there will be an investment. So now instead of investment, you are adding the assets and liabilities, so there will be no investment. Then assets and liabilities are simply a cross cast, that is you add one by one. Then impairment of goodwill is recognized in P&L. So if there is any goodwill which arise when you remove the investment and add the assets and liabilities, then that goodwill is to be tested for impairment every time, which was not there in the accounting standards. Then non-controlling interest represents subsidiaries net asset that are not owned by the parent, which is fine. Then there are two methods to measure NCI. We will discuss those methods in the later slide. These are the two methods. One is the fair value method to recognize the minority interest. In the accounting standard, there was only one method. Here there are two methods because it works on the fair value concept. So minority interest will also be on the fair value. So, and second is the proportionate share method. So in this example, if you see, there is A Limited which requires 75% of B Limited at a valuation of 130 crores. So for 75% stake, there is a valuation of 130 crores, and they are paying 120 crores for this, right? So you have to compute the goodwill and capital reserve by applying the fair value method and the proportionate share method. So here consideration is 120 in the fair value method. Non-controlling interest will be, since the consideration is 120, okay, so basis this you will work out what is the share of 25%, which is 40 crores. So for 100% stake, okay, 75 plus 25, what is the consideration? Total consideration for 100% stake is 160. Then what are the net assets for B for 100% stake at a valuation of 130? So this is for 100% in this example. Okay, so the goodwill is 30 crores. Okay, now here if you do the proportional share method, consideration is same. Now non-controlling interest is net assets into their proportionate share, that is this is valued on the 130 crores. Okay, what is the valuation into 25%? So this is the total valuation. Then net assets are 130 and this is the goodwill. So if you work on a fair value method, then there's a separate goodwill. If you work on a proportionate share method, which we used to do in accounting standards sometimes, then this was not accounting standard or erstwhile accounting standards. So the goodwill is 22.5. Okay, and obviously minority interest will also be recognized on a different number. So here minority interest will be 32.5. Here it will be 40. Okay, so the total is 70. Here the total is 30, 40, 55. Okay, so this is we have discussed intercompany balances. This is fine. So unrealized profits we can discuss by way of an example. Okay, one thing important on this slide is the unrealized profit has to be determined if the parent is selling the goods to the subsidiary or the subsidiary is selling goods to the parent. So both way you have to determine the unrealized gain, because in both the cases inventory will come in the consolidated financial statement. So if A is selling goods to B with a cost of 100 and they're selling it to B, which is a subsidiary, at 150, so the inventory will stand at 150 in the consolidated books. Similarly, if the subsidiary sells 100 rupee good at 150 to the parent, then also the inventory will come at 150. So in both the cases inventory will have a unrealized value of 50 rupees. So you have to see from a group perspective that whether there is any unrealized gain. So if that inventory is already sold, then there is no adjustment required because that 50 rupee has already been earned from the third party, right? They have paid you. So there is no unrealized. You are not earning within yourself. Okay. So now, so these are the ways how you eliminate. So as a parent, adjustment is made to the consolidated financial statement as a to the inventory and also to the closing inventory in the statement of comprehensive income. So one is you have to reduce the inventory by the unrealized profit, and the second you have to remove the uh, profit and loss number because there is a profit which is coming in the financials of the seller. So when A has sold the goods to B, there is a profit which is coming in the sale and purchase of B. So there was a purchase of 100 and he sold at 150. So there's a 50 gain which is coming in the PNL of A. So when that PNL gets consolidated, then there's a 50 rupee gain which is not realized. So we will remove those 50 rupees from the sales, and then second entry you will pass, you will reduce 50 rupees from the inventory. So in a way sales debit to inventory. So that's how the inventory will the entry will get nullified. So this is an example. A parent company sold goods of costing 200 lakhs to its 70% subsidiary at 240 lakh. 50% of these goods are still lying at stock. B Limited has measured its inventory at cost. Show the necessary adjustment. So maybe you can read the example. So if we work out here, so inventory was sold at 240 lakhs. Out of this 240, it says only 50% is left. So 120 lakh inventory is still lying in the books of B. Okay. And what is the profit on this 120? So this 200 was sold at 240. That is 40 rupees profit divided by 2. This is 20. So inventory should be valued at 100 and you should reduce this profit of 20 from the inventory. So the total profit gets reduced by 20 lakhs. So when the total profit gets reduced by 20 lakh, you have to create this deferred tax adjustment and create an asset. Why? Because company A would have paid tax on 40 rupees. Okay, tax on 40. So when you will prepare the effective tax rate for company A, so it will have a tax of 40. Okay, tax of 40 into 30, 4 is a 12. So 12 rupees tax on a profit of 40, but in the CFS it will be tax of 12 on a profit of 20. Why? Because we have removed 20 lakhs profit, right? So this will be an absurd picture. So A has already paid extra tax from the perspective of CFS, not from standalone, because in standalone they are a separate legal entity, they have to pay 12 rupees tax. So from consolidated purposes, there's a deferred tax asset which will be created because there's a 6 rupee tax which has been paid extra because the goods are not moved out of the group, right? This is also similar nature if you're selling any current assets or non like PPE or any any other assets at profit, then you have to remove that profit from the respective property, plant and equipment or other non-current asset and the income or the profit and loss account. So this is dividend which is received from the parent to subsidiary. So since it is an intercompany item, that also gets eliminated from the parent's dividend income, and it will get adjusted from the reserves. So sometimes certain subsidiaries, there are strategic decisions which are taken to acquire those subsidiaries from the point of view of a sale in the near future. So that subsidiary is not required to be excluded from consolidation because the control is temporary. If it meets the criteria, then it has to be consolidated, and if it meets the criteria of held for sale or the sale under discontinuing operations, so you will show that separately under Ind As 105. So this concept of temporary control, which was there in the accounting standard, does not arise here. Now, this is certain. There are certain ITFG clarifications on how to do the accounting treatment for depreciation, for the dividend distribution tax, and for the partial deemed disposal. So you can go through this example. It's a simple example. Parent had 70% stake in the subsidiary. There was another investor, additional funds, who had put in the additional funds, like the example we discussed just now, the 66% and 34% stake. So because of the additional funds being invested, there was a loss of control. Oh, sorry, it reduced the parent stake to 60%. However, there was no loss of control in this case, but the case we discussed, there was a loss of control because there was an agreement which stated that with 66% stake, you will not have the entire control. There will be a joint control between both the investors. So in this case, there is no loss of control, but there is a change of control. So how this partial deemed disposal? So there is a deemed disposal of 10% of the stake should be accounted for in the financial statement. So the treatment in the separate financial statements, as in the standalone financials of the parent, there will not be any impact, and investment in the subsidiary will continue to be recognized at the current value. Why? Because parent had acquired 70%, subsidiary say at 100 crores. Still they are having 100 crore, but their stake has reduced, so they have not got something extra for this 60% stake, so their cost remains 100 crore because subsidiaries measured at cost here, not at fair value, so their cost remains same at 100 crore. So in the separate financial statement, there will not be any change because there is no loss of control. If there's a loss of control, then this has to be fair valued, because in that case you are selling a subsidiary and acquiring another entity, because it's no longer a subsidiary. Okay, so it can be a JV, it can also not be a JV, it can be just a simple investment also. And in the consolidated financial statement, this transaction will not have an impact because earlier also this company was getting consolidated. Now also it is getting consolidated at 60%. So in case of 60% stake, in case of 70% stake, in both the cases, you will consolidate this company at 100% of the assets and liabilities, and there will be minority interest of 30% and 40% respectively. So from consolidation perspective also, as long as there is a change in control and control still exists, there is no treatment which is required in standalone and consolidated books. If there is a loss of control, then it requires a treatment, because in case of loss of control, there is no longer a control and you are not consolidating that entity. So any difference which arises, that will be recognized directly in equity, because your minority shareholding will get changed, so there might be a difference between this 30 to 40, that will be adjusted in the equity. Now, accounting treatment of dividend distribution tax in the consolidated financial statement in case of partly owned subsidiary in the following scenario. H Limited holds 12,000 equity shares in S Limited with 60% holding. During the year, S Limited paid a dividend of ₹10 amounting to 2 lakh. Okay. So 60% shareholding and dividend distribution tax of 20%, which is 40,000. Should the share of H Limited in dividend distribution tax, okay, which is 60% in this, be paid by S Limited amounting to 24%, 24,000, be charged as an expense in the CFS or not? So now since this dividend gets eliminated in the consolidated financial statement in the intercompany transactions. So the dividend paid by S to the H Limited is no longer appearing. So the tax is also an extra cost which the group has to bear because they are preparing the consolidated financial statement. It's a single entity. So because of the legal entity, they have paid a tax. In case of sale and purchase transaction, which we discussed earlier, the inventory adjustment, there might be a GST also, which is paid to the government. That GST is not going to come back. So that's an additional cost, right? So this additional cost will be recorded as a separate cost. So it should be charged as an expense in the CFS. Now, the treatment of depreciation, when different method depreciation is applicable. In that case, if there's a different method, you have to make the changes and make the methods same if it is a different policy. But here it is a different method, so there's a difference between the method, change in accounting method, or a change in accounting policy, and change in accounting estimate. So changing the method from WDV to SLM. Okay, so this is not a change in the accounting policy. It is an accounting estimate, how you are estimating your depreciation to move throughout the year, right? Earlier it was a change in accounting policy, but it is a change in accounting estimate. Selection of the method of depreciation is accounting estimate, because you are selecting a method basis upon your industry and the company's business, that how the equipments are going to depreciate, whether they are depreciating on the same manner year on year, or they are depreciating on a reducing method. So that depends upon the industry. So companies estimate how their equipments get depreciated. So that's why it's an accounting estimate, not a method. So this slide is on discussion on difference from accounting standard 21, the erstwhile accounting standard, and Ind As 110. So we discussed there's a difference in control. So this was rule based. If it is more than 50% or half of the voting power and half of the composition of board, then there's a consolidation requirement. But here it does not go by that way. There should be a power to control. So it can be with less than 50%, it can be with more than 50%, and you should have the ability to exercise that power over the returns. Then potential voting rights were not discussed, or they were not stated in accounting standard 21. In case of erstwhile accounting standard, if it was not practicable, then you need not make the consolidation basis uniform accounting policy, then you can disclose the fact. But here it has to be followed. There is no impractical situation as such. Then excluding a subsidiary from consolidation, here everything is to be consolidated. Here if it was a temporary control, it was there was an exemption which was given, or there were certain long-term restrictions which will impair the ability to transfer the funds from that subsidiary to the parent, then there might not be a consolidation requirement. Then notes, there are all the notes of this SFS will come to CFS, but here there's no such clarification whether all the notes are required. But CFS is a primary, secondary book, and SFS is a primary book. So, but Ind As considers CFS as the primary and SFS as secondary, which we discuss like it's there in the other parts of the world, where under this standard, SFS was primary and CFS is secondary. So all the notes are not required to be disclosed. Whatever are relevant from the CFS perspective, Schedule 3 states those notes, those only are required as per Schedule 3 and relevant accounting standards. Then treatment in case of more than one parent of a subsidiary. So two investor can control an investee, where we will account for those entities as a joint control entities. Here, where an entity is controlled by two enterprises, then it will be considered subsidiary of both the controlling enterprises. There was no concept of joint control for these entities, and therefore both the companies will have to consolidate. But here both the companies don't have to consolidate, so because it will give a wrong picture from the financial statement perspective and from the user perspective. Then the reporting date gap, here it was 6 months, and here it is 3 months. Minority interest should be presented within the equity separately from equity. Here it was presented separately from liabilities. It was below the liability line. Here it is below the equity line. Then allocation, if there are losses and how to allocate, then losses should be attributed to the parent and non-controlling separately if it results in the deficit. Okay. Here excess of loss applicable to a minority over the equity subsidiary and any further losses. So here whatever losses were there were adjusted against the majority shareholders. Here you can show it as a recovery also. In the erstwhile AS, it was not to be shown as a recoverable. We have never seen any minority interest as a recoverable one in the erstwhile accounting standard. But here you can show it as a recoverable unless and until there is a restriction in the agreement that minority shareholders will not bear the loss. Then you cannot show it as an asset. Then parent has to bear that loss. Loss of control, we have discussed. There's no guidance here, but here there's a proper guidance how the loss of control is to be treated.
Okay.
Okay, so we can move on to questions if there are any.
We'll try to unmute the participants, ma'am, and those who have any questions, they can unmute and ask. Actually.
Okay.
And there is one question that came up in the session is, in case of cross holdings, how to determine the control? That is one question came up at the start of the session. And
In the chat box?
no, in the questions panel, it won't be visible to you. I need to make you organize. I'll put it in the chat box also.
Yeah.
In case of cross holdings, how to determine the control? That is the question.
So in case there are cross holdings from one company to another company, say A is having shareholding in B, say 50% or more than 50%, and B is having shareholding in A, then you have to see which company is influencing or has more power to take the decisions, right? If A has the power to take the decisions over B, then A is the parent company, or if B is having that power to affect the decision making and the relevant activities of A, then B is a parent company. If you feel that both the companies can control, A can control entirely B, and B can also have similar powers to control it, that's practically not possible, because if I am controlling you, so there are very less chances that you will be able to control me also, because I'm controlling myself also and your company also. So that's a very rare situation. So you have to assess which company is controlling and which has the power to control the activities. How do you unmute?
No, I have unmuted participants. And
No.
those who audience, those who want to post any questions, they can unmute and ask. I'm unmuted as organizer. Wait for a minute. If not, so if there's any question that comes up to SIRC, CP, mail ID or something, we'll share it to you. And time permits, you can respond. And we hope the presentation will be shared with us as a soft copy in the PDF format, so that you can circulate among the audience, along with the recordings of the session in the due course. 1 minute. I just check for any questions, or else we'll wind up the session. There seems to be no questions actually from audience and on microphone and part. We'll check for chat box if any, if not, so we won't have. There are no questions, ma'am. Thank you so much for the time
Yeah.
spent here on Ind As 110, ma'am. On behalf of treasurer who couldn't join at the end for vote of thanks, and office bearers and chairman secretary in their absence here, thank you so much for your time spent here on knowledge dissemination of Ind As 110. In future, we look forward to have you in a physical session in SIRC Chennai for the same topic or some other topic on the standards. Thank you so much for the time.
Thank you so much, everyone. Thank you.